Stablecoins like Tether are often seen as the anchor of the cryptocurrency market, providing a predictable and stable value. The recent downturn in the crypto market, coupled with the bankruptcy filing of FTX, has sparked concerns about the stability of stablecoins, particularly Tether, the largest stablecoin in the market. Tether's latest financial reports have further fueled these concerns and raised questions about the sustainability of its business model. This is V-Circle Future. What are the risks highlighted in Tether's latest financial reports? How will the collapse of FTX impact Tether? In the video, we will explore some potential complications. Let's start with understand what Tether is. Tether, USDT, is a stablecoin introduced in 2014 by Tether Limited. It is based on blockchain technology and is pegged to the US dollar. Tether Limited is owned by the Hong Kong-based firm Bitfinex, which also controls the cryptocurrency exchange Bitfinex. Tether aims to provide a safe digital asset with a stable valuation. However, the significant declines in the crypto market this year, compounded by the recent bankruptcy filing of FTX, have raised concerns about the stability of Tether, the largest stablecoin in the market. According to Tether's latest reports, the vast majority of its assets are in cash, treasury bonds, and other safe instruments easily converted to dollars. However, the volume of loan increased about 35% for the last quarter, from $4.5 billion to $6.1 billion. Tether allocated more assets to its loans business. Tether tokens don't pay interest, so Tether can easily profit by investing in safe, low-yielding securities such as treasuries. Typically, lenders charge borrowers higher rates than treasuries pay, which makes lending potentially more profitable. Tether refers to these loans as secured loans, but provides little information about the borrowers and the collateral accepted. Tether's spokesperson, Ms. Welch, declined to comment on whether the collateral includes cryptocurrencies. Here is the tricky part. Tether's reports only show the dollar amounts for the loans, and do not indicate whether the loans were made in Tether tokens. This raises questions about why the company would lend its own coins to customers instead of selling them for hard currency upfront. This shift in Tether's strategy adds to the risk that the company may not have enough liquid assets to pay redemptions in a crisis. When the reserves include 9% in the form of loans, it raises potential risks. Loans are different from cash and treasury bills because Tether cannot be certain that the loans will be paid back. Another uncertainty is the collateral. If the collateral for Tether's loans includes cryptocurrencies, it means that some of the collateral held by Tether could be worth less than it was when the loans were made. For example, Tether's statement shows that Celsius used Bitcoin as collateral for its loan from Tether. Since Bitcoin has fallen 63% this year, the value of the collateral has also declined. This adds to the uncertainty and potential risks associated with Tether's secured loans. Because Tether's loans are denominated in Tether tokens, their market value fluctuates with the price of Tether. This means that the market value of the company's reserves also fluctuates. As William Vandenberg pointed out, if Tether falls, and they have loans that can be repaid in Tether, then by definition it's not backed up by a dollar. If the premise of Tether changes, it could have far-reaching implications for the entire stablecoin market. Over the years, there have been several incidents where Tether has experienced depegging from the US dollar. For example, during the early years after its launch, USDT tumbled to an all-time low of $0.5683 on March 2, 2015. However, it quickly regained its value and regained its price parity with the US dollar by March 15. More recently, on November 10, 1 unit of Tether fell as low as 99.7 cents, and on May 12, it fell as low as 99.5 cents. Despite these incidents, Tether has managed to maintain its value at $1. One of the biggest concerns for investors is Tether's thin capital cushion. Tether's latest reserves report, released on November 10, showed total assets of $68.06 billion and total liabilities of $67.81 billion as of September 30. This left a thin capital cushion of about $250 million, equivalent to just 0.4% of assets. A 4% reduction in the value of Tether's loans would have erased the company's $250 million capital cushion. This is not an unlikely scenario, as it has become common for banks' loans to trade at a discount to their book value. In fact, among publicly traded U.S. banks listed on major exchanges, 36% of them reported that their loans' market value was more than 4% below their balance sheet amount as of September 30th, according to data provided by S&P Global Market Intelligence. These numbers illustrate the potential risks associated with Tether's loans and its thin capital cushion. So what is it like in the traditional financial market? Banks are required to hold large capital cushions to absorb losses in case their assets decline sharply in value. Money market funds must hold short-term assets with minimal credit risk. As of October 31st, none of the $5 trillion of assets held by U.S. taxable money market funds were loans, according to Crane data. SEC rules have included minimum liquidity requirements for money market funds, MMFs, since 2010. These require a minimum of 10% of investments to be in daily liquid assets, DLA, and a minimum of 30% in weekly liquid assets, WLA. MMFs report the size of their DLA and WLA to the public daily on their websites. These requirements serve as liquidity buffers. Another big concern for investors is Tether's lack of transparency regarding whether any of its loans are to related parties. Tether's reports used to explicitly state that none of the loans were to affiliated entities. However, starting with its report for the second quarter of 2022, Tether dropped this language without providing an explanation. When asked about this, Tether's Ms. Welch declined to comment and also declined to provide information about how much, if any, of Tether's loans were to related parties as of September 30th. This lack of transparency is a red flag for investors and adds to the overall uncertainty surrounding Tether's secured loans. Besides the issues related to loans, Tether and its parent company have also faced several controversies in recent years. In 2019, New York Attorney General Letitia James accused Tether Limited of concealing an $850 million loss by tapping into Tether's currency reserves. Tether settled with James in 2021, agreeing to pay a $18.5 million fine and discontinued trading with New Yorkers. Despite this, Tether denied any wrongdoing and stated that it simply wanted to move on. In June 2020, a class action lawsuit was filed against Tether, accusing the company of manipulating the markets by issuing USDT to itself without dollar backing and then selling the USDT to Bitfinex. In October 2021, the Commodity Futures Trading Commission, CFTC, filed an order settling charges against Tether Holdings Limited. The ruling required Tether to pay a $41 million civil penalty and prevent further violations of the Commodity Exchange Act, CEA, and CFTC rules. The decision also forced Bitfinex to pay a $1.5 million civil penalty and implement measures to avoid unlawful retail commodities transactions. Lastly, let's talk about Tether and FTX. It's important to note that the situation is not as straightforward as Tether's official statement might imply. The collapse of trading firm Alameda has sparked speculation about the potential impact on Tether. Tether states that Alameda, as a large issuer of USDT, originally sent USD to Tether and received USDT in return.
Those reserves are still in Tether's possession, they are not on Alameda's balance sheet. The collateral backing Alameda's USDT is not on Alameda's balance sheet.
While this statement is technically true, it's important to consider what Alameda can do with their USDT. As they can only redeem their USDT for USD via Tether's redemption facility, their options are limited. This raises questions about the stability and usefulness of USDT in certain situations. The bankruptcy of FTX and Alameda could result in the auctioning off of significant amounts of cryptocurrency. This could have far-reaching effects on the cryptocurrency market, potentially causing a domino effect and leading to the downfall of other crypto firms and tokens. The FTX contagion may continue to spread, with more news expected in the future about companies such as BlockFi and Solana blockchain. We will continue to investigate and provide updates on the situation. This is V-Circle Future. Thank for your watching.